Welcome all. Steve Parisi here with IBC Global. Hope your day is off to a great start. Today we have our guest Scott Witt with us today. Scott, how you doing?
Good. Good morning, Steve.
Morning. So today we've got a fun topic to talk about. This is one of my favorite topics and really initially one of the reasons why we had connected. I had reached out to you. Well, first we had connected with a mutual client I was working with at the time, inquiring about this exact topic, which is policy design. We could talk about this all day. So to kind of get into it, because with your background, I think the insight you provide is so valuable beyond mine and any agent out there for that matter, because my ultimate goal when I'm working with a client is to maximize the cash value for them. But at the same time, I'm compensated by putting policies in force. That's how I drive my business. Whereas you, if anyone's going to work with you, you're not comped in any way, shape, or form from any policy sale. We've talked about this before as a fee-only insurance advisor. So that background and being an actuary, I think is going to speak a lot of light or shed a lot of light here as far as how to truly maximize the cash value on a life insurance policy.
Yeah, and I think just to piggyback on that a little bit, and I know we've talked about this before, but just to quickly recap, no matter how ethical and professional and proficient you are as an agent, a conflict of interest is inescapable. Because you only get paid if the policy gets put in force, and so at the end of the day, you prefer a case that ends up with you getting paid in some capacity. And this doesn't apply to you, I realize, but to most agents out there, they have a conflict of interest in receiving the most agent compensation possible. So given a choice between door A and door B, if door A is a minimum compensation policy for the agent and door B is a maximum commission for the agent, most agents find it irresistible to try to steer the client towards door B. And it creates really a dilemma, a moral dilemma for a lot of agents. I don't suffer from that moral dilemma because if a client engages my services, I serve in a fiduciary capacity looking out only for their best interests. And like you said, I get paid the same no matter what they do. And that includes not buying insurance. And so frankly, some people will come to me and I'll say, look, you're not a good fit. They may be, we're looking at the infinite banking concept and that's how they stumbled on these videos. And maybe that's how they got to me. And I will tell a decent amount of people like, look, this just isn't a fit for your situation right now. And maybe it will never be a fit for your situation. And that's fine. And sometimes I might steer them towards just some term coverage, or maybe we find out that their situation just doesn't really call for any sort of life insurance. And that's okay. I'm not coming into this with a preconceived notion that, all I have is a hammer and everything looks like a nail. Right. And that's a common refrain you hear regarding cash value life insurance. And I do agree. I mean, it's incredibly flexible and it's a Swiss Army knife, but I always chuckle when I hear that, that life insurance agents have this hammer and everything they see is a nail.
Yeah. No, I'm with you. At one point you mentioned there, so from industry experience, I mean, what I can tell you as far as agent compensation, like I'm not against agents getting compensated. They're driving a business. I view it, our business, it's a volume play, doing the best possible service for a client. Like we want to set them up where they put $1 into a policy, it's maximized. I mean, it's their money you're working with. You don't want to try and take it away if I get a higher comp. In my mind, like that just wouldn't be right, and if I told my mom that when I was a kid, it wouldn't go well. Let's put it that way. Just how I was raised.
Yeah, well, I think what it really sheds a light on is that the agent compensation model in the industry is really broken.
Yeah.
You are able to do what you do because I'm guessing because you've never really known anything else and you've been able to approach this, that this is how I'm going to do it. You have a nice volume. You don't spin your wheels a lot on cases that have little or no chance of coming to fruition. People, you put a lot of information out there. People know about you. They know what they're getting. You're not doing a lot of cold calls. Hey, I've got something to try to sell you here. Put yourself in the shoes of a typical agent that has to work so hard just to get an appointment, just to get their foot in the door. then even when that happens, there might only be a small fraction of the time that they actually get something into the application process.
Yeah.
And then that funnels it down even more. And you go through the application process and it's hard to get somebody to the finish line. Like maybe something goes wrong in underwriting. Maybe there's a competing agent that you didn't know anything about. Maybe they get cold feet right at the end. You thought they're going to buy $1 million. Instead, they end up buying 200,000. Whatever the case is, it's really hard to get paid. And if you step back and you say, man, I need to make, 100,000 a year, 200,000 a year, whatever it is, a typical agent needs to make up for all of their lost time and effort on those sales that didn't go anywhere. The only way they can get where they want to be is by charging full commission to the people who actually see the process through to the finish line. So I understand that it's not well received by the agent community, that there are people out there that are making a living doing what you're doing. And frankly, people that do what I do, that, when I'm obligated to put the best foot forward for a client, I'm obligated to look at minimum commission designs if I feel like that is maximizing their value. Mm-hmm. And so there's a very, very small subset of agents out there that have this almost subculture of maximizing value for policyholders. The rest of the agents feel justified in trying to sell full commission policies at every opportunity because they think they've earned it. And I can't tell you how many agents have given me that exact speech. I cannot make a living if, when I finally get to sell a policy, I cannot make a living if I sell that on a minimum commission basis. And I'm sympathetic to that, but unfortunately a fiduciary obligation in this situation, it actually means something. And I can't change my advice just to make the agent feel better or just to compensate them for the 90% of the cases that they didn't get to see to the finish line.
Yeah, I'm with you, and I can share stories on that too. Let's kind of use that as a bridge into designing a policy for maximum cash value, because the whole topic of policy design, I love it, and I talk about it all the time, and some people are probably sick of me talking about it. But if I'm a client or a prospect and I come to you and I say, okay, my goal, Scott, is to design a policy, or when I pay money into this cash value life insurance policy, I want to maximize the cash value, and I want it maximized long-term, upfront. How do I get the best value long-term? But if possible, I don't necessarily want to sacrifice the early cash values either, because there is a lot of information, and I've seen it in the industry where if you take less upfront, you could have more long-term. But to kind of get back on point, my goal is to maximize cash value. Say I'm paying in any amount of money, it could be $100,000 per year. Where can it go, right? And you and I know this, base premium, PUA, but how do I make sure that it's truly optimized, and how would you kind of coach me through that?
Yeah, well, there's probably no substitute for experience. When you deal with these companies, every company is different. You've got, as you mentioned, you've got the base, the term piece, paid up additions, riders, and every company has a little different flavor of how those things put together. Different ratios and different amounts in relationship to each other is probably the best way to describe it. And we talk about blending conceptually, and really the amount of blending in my mind is how much term you have in the policy. And so when you hear people talking about a max blend policy, in my mind, usually that means you've minimized the base as much as possible and maximized the term as much as possible. Many agents hear that and they think, oh no, that's all, that's very risky, and I'm not going to get involved with a risky policy. But what they may fail to recognize is then you've got this whole separate component of paid up additions, riders, or whatever you want to call it, the terminology that different companies use. But these are additional premiums that are put into the policy above and beyond the premium that is associated with the base and the term piece. And that extra premium does a lot of things positively for you. It's that extra premium is typically compensated on a very low basis for the agent. And that term, that those extra premiums usually are used towards replacing the term insurance. And so you have a decreasing amount of term insurance inside these max blend policies. And, you and I have played around a lot with a lot of different options and what optimizes flexibility. But usually after a time, the term insurance is replaced or the term insurance drops off. And the other piece of this that's extremely complicated, and you are as good at it as anybody I've worked with, is understanding how this affects the modified endowment contract limits, how it ties in with the definition of life insurance. And different companies give you different flexibility with respect to how you can decrease the death benefit down the road, how you can adjust the premium. And so every case is different. Premium flexibility, death benefit flexibility, whether or not you need access to the cash. And that gets us into something we've talked about before with direct recognition and non-direct recognition loans. If somebody's really trying to be a disciple of the infinite banking concept, that there's some issues that are going to come up in talking with somebody like that. So it is so much more complicated than just saying, hey, Steve, can you give me a max blend policy? Like we have to know with each company how all of these different design components interact with the modified endowment contract rules. I know you and I have talked before about the relevance of guarantees, and then each case has its own unique demands with respect to policyholder flexibility and their goals. And it is a very, very complicated process. And like I said at the beginning of this, very long-winded answer, there probably is no substitute for experience. You just got to see, you got to go through the process, trial and error, see what works. And it's amazing what you can achieve if your mindset is doing the best you possibly can for the client. If your mindset is just, let's get this thing placed and, keep it simple, keep my time to a minimum, it's not that complicated. But, and this probably keeps you up nights. There's a bit of a paradox there. The harder you work and the more time you spend, often the less you get paid on a case.
Agreed. And that's happened, especially in the early years when it took me longer to produce illustrations and we didn't train a team. That was the case. I remember a time shortly after I got married, working on larger cases, and they're competitive at times. Like, okay, how do I keep maximizing this guy's cash value? And I would look at the guaranteed, non-guaranteed, short-term, long-term, and we continue to drive that premium down, which drive the comp. I'm like, I don't care. We just want to get the business and make sure he's set up properly. But every single time we did that, they had greater cash value and they're in a better position. And we got the business too. And that just goes back to call it from an ethical standpoint. Like if you do the right thing for people, they're going to be satisfied with you. It's their money, so it should always be set up. But it's going to come back. Like it stays on the books, you got the residuals, and they're going to refer you business. Like just set it up right, and it's going to come back to you. Yeah, right on. Well, no, thanks for going into detail there, and especially the point on experience. I'll often look at it where if someone says, "Hey, I want to put in, say it's $100,000 per year for 10 years." Right? A lot of times when we design policies for corporations, that's what they would do, but they do it on a number of executives. So they've got 7 figures total going into a policy on a non-qualified SERP. And what I liked about them, they were big on immediate cash value because it was an asset on the balance sheet. And that is very appealing to individuals too, because whether I have a formal balance sheet for myself or not as an individual, it's still money that I have access to or I don't have access to. If I'm paying $100,000 into a policy, I can have $50,000 in cash value, or I can have $90,000 in cash value right off the bat, break even between 3 and 5 years, stop paying at 10 years, and just have positive cash value moving forward. And what I found based off of historical performance is when you set a policy up like that, kind of with that max blend, call it, where it's rich equity up front, that has produced stronger long-term results. And again, that's based off of what I've seen on the corporate planning side with older policies and then what we've set up for individuals as well.
Yeah, I agree. And I think if you're dealing with straightforward companies, it's hard to argue against having more cash in the policy earlier. There would have to be something strange going on with the policy. And I know you alluded to this briefly earlier. I know there are some designs out there that suppress cash values in the early years, and then suddenly you see some bonuses or some things magically appear 15, 20, 30 years down the road. Um, those may admittedly make me a little bit nervous. You know, I think in this case, I'd rather have a bird in hand rather than two in the bush. And
I like that.
the companies that we're dealing with when you and I work together are well respected um, companies that have a proven track record of performance. And the reason they have separated themselves from the competition is not through some sleight of hand or unsustainable gimmick, but rather the underlying fundamentals. And
Right.
I'm sure we've talked about this before on another podcast, but really what every cash value policy comes down to: four things: investment performance, underlying mortality experience, expenses, and then another often overlooked component that affects all three of those would be persistency on a policy. At what rate do companies keep their business on the books? And if you can find a company that shines in all four of those factors, they have outstanding general account performance. And just one quick point on that, the companies that you and I tend to favor are a little bit more aggressive in terms of their allocation. They're not 99% in bonds. They might be 85 to 90% in bonds. And with that other 10 or 15%, they might be investing in some other areas of business in their own company. They might be in equities or equity-like instruments, but they have driven up their general account yield a little bit with some risk on the margin. And that gives them a long-term crediting advantage that a company that was 100% in bonds would not enjoy.
Yeah.
So that's the biggest component in the policies that you and I are generally talking about, is that underlying general account performance.
Right.
I would say the next most important, probably tied, would be mortality and expenses. Simply put, on mortality, if your company if you've been underwritten well, if you qualified for a good price class and your company has low mortality experience in general, that flows through to higher long-term policy value. With expenses, the one that's most notable and most significant in what we're talking about here would be agent compensation. And if you can reduce agent compensation, that gives you an advantage over policies that do not minimize agent compensation. And then with persistency, it can positively or negatively impact each of those other three factors. But all the bells and whistles, all the gimmicks, at the end of the day, if you can't explain why the illustration from the company you're looking at is going to be better than another illustration you're looking at, and you can't explain it in terms of one of those four fundamental factors that I just described, there's a good chance that you might just be looking at a paper promise that is unlikely to come to fruition.
Right. Good point. No, thanks for sharing that. So that a couple things you said leads into two other points. One on commissions. So I did a commission study recently, because I'm always interested in this, where we took several different policy designs for an individual because they had requested, hey, can I see these different designs? And by the way, Steve, I would like to see what the commission looks like as well. So the first goal was to maximize his performance, right? He had a lump sum going in. We spread it out over a certain number of years, optimize the cash value, but we did it in different patterns, more upfront, spreading it out over 5 years. And what was consistent, both on the guaranteed and non-guaranteed values with two different companies, was every single option that gave him greater cash value, short-term and long-term, paid the least compensation. So it's always interesting to me, because I've seen that time and time just occur with every policy we look at. And I guess from an actuarial perspective, when you hear that, it's just kind of something like, yeah, I mean, that's how it works when you look at how insurance companies have it set up. As far as the elements that go into it, how policies are priced and such. If a commission is minimized from a net performance standpoint, will that 10 out of 10 times, or is it 8 out of 10 times optimize the cash value for the consumer?
Okay, that's a great question. And I would separate that into non-guarantees and guarantees. And as long as we stay out of a guaranteed environment, which we can talk a little bit more about that later if you'd like. But as long as we stay out of a guaranteed environment, I think it's got to be close to 10 out of 10 that the advantage is going to go to the policy that has minimized agent compensation. I just think that's common sense. If you put more money in the policy on behalf of the policyholder upfront, and basically you're taking money from the agent's pocket and putting it into the policyholder's pocket in the form of extra cash value right out of the gate. Mm-hmm. If you give a policy a head start like that, it's going to be subject to the same mortality, expenses, interest, each of those policies, whether it's full commission or low commission. How can the full commission policy ever overtake the low commission policy? Yeah. There would have to be something like, oh, the full commission policy allowed you to have a lower death benefit, or it got you a higher crediting rate. You know, the company threw you a bone somehow, and over the long haul, that made up for the loss of, the agent compensation somehow.
Yeah. And one thing I'd like to interject there, because I got this all the time from managers I worked for when we set policies up for individuals, a little bit in the corporate side, but that didn't matter, was the higher commission. We'd always hear, well, if you've got a higher base premium, the company can potentially pay greater dividends because dividends are more favorable with some companies to base premium dollars as opposed to PUAs. And the thing is, like, when I dig into it, I'm like, okay, I see that when I dig into the policies, but every single policy I've seen, especially that's under delivered, meaning the illustration looked great and then it didn't pan out, the higher the base is, the more that's occurred. And that's just where I look at it and get concerned, call it from the agent perspective, to say, well, if you do that to someone and it under delivers, you're kind of setting yourself up for them to come back and say, hey, Steve, you jerk, like, why'd you put me in that? Like, I thought I was going to have X and it kept producing less and less.
Yeah, I don't. Nothing you said there changes my opinion. I still think you're better off minimizing the agent compensation. I agree with you that there's a lot of confusion. I think a lot of agents just don't understand it. And you mentioned something like, oh, the dividends are bigger. Well, your listeners might be better off just ignoring dividends entirely, in terms of, like, when you compare one illustration to another, even within the same company, and you say, oh, the dividends are higher here. That's very misleading. What really matters is the cash value.
Right on.
Because there's multiple ways to get there. And really the dividend is the balancing mechanism to get the cash value to where the company has computed that it needs to be. And if you're operating in a guaranteed environment, then you'll have a zero dividend. Yeah. And so there's this math that occurs behind the scenes. The company figures out what are our actual investments, what's our actual mortality, what are our actual expenses. And they say, based on your guaranteed cash value at the start of this year and the premiums that have come in, here's where we think your cash value should be at the end of the year. And then they compare that with the growth that you would have had due to the growth in the guaranteed cash value, and any difference between the total cash value that they've computed and the guaranteed cash value, that essentially is the dividend. Gotcha. And by comparing one dividend to another across policy designs from company to company, you're more apt to make bad decisions and bad conclusions when you do that. What you should be comparing is the cash value. Mm-hmm. Like, I don't care how we get there. And this, not to make things more complicated, but but if we looked at a universal life policy, it's built differently. It's got the same components, but the way it's constructed, it's more transparent. It's split out more. When I make that comparison, I'm still just looking at the ending cash value, which is better, whole life, universal life. And I'm not looking at, because that's a dramatic example. There are no quote unquote dividends on a universal life policy. Well, does that mean that whole life is better because it has higher dividends? So I think moving away from this notion of looking at the absolute value of a dividend and thinking that means something. The dividend is a mechanism that on a whole life policy, the insurance company uses to share experience with its policyholders. And if you have a company that has good investments, good mortality, and good expenses, you're going to be better off than you would have been. And the
Right.
dividend is the mechanism that's going to help you get there.
Gotcha.
Separately, now we've identified another way that you can be better off, and that's through the policy design with the how you blend the base and the term and any paid up additions together.
Gotcha.
So that's a lot of talk about non-guarantees. Now let's talk a little bit about guarantees. And I think this is more complicated and perhaps a little bit more sophisticated. There are policies out there, and it's probably actually more obvious on the universal life side, but there are policies out there that have stronger guarantees associated with the higher commission levels. And that is the carrot that life insurance companies put out there. That's what an agent can cling to in some of these situations, is this idea that I just refuse to sell my policy, or to sell my clients a policy with such low guarantees, and I'm going to sell them a policy with higher guarantees. And yes, there's higher agent compensation with that, but it's kind of the price of admission. If you want stronger guarantees, you're going to have a higher base, and you're going to have to pay me more. I would suggest that in some cases that may be true, but in vastly more cases, the agent simply believes it's true. And they believe it with all of their heart, that I refuse to sell a minimum commission design because the guarantees are so poor. And so that is sort of their justification for never dipping their toes in the minimum compensation waters. You and I both know that the reality of the situation is, when you drill down deeper, it's possible that the minimum commission policies have even stronger guarantees. That can vary from company to company. There's also this notion of what's a real guarantee, and what is illustrated on the illustration, and what is a contingent guarantee. If the policyholder lives up to their end of the bargain and actually puts in these paid up addition rider payments, in many situations, they're actually buying, they keep ratcheting up the guarantee, because those are payments that maybe were not 100% counted on in the illustration. Does that make sense? Some companies are very conservative with what they're willing to show as a guaranteed cash value on an illustration. And if I have a client that has a $100,000 payment due, but only $10,000 of that payment is a contractual premium, the company may put the illustration together as if only the $10,000 is coming in for sure. They may not give the policyholder credit in the guaranteed cash value column of the illustration for the additional $90,000 that they fully intend to put in.
Yeah.
And when we roll around to that year and they do put in the 100,000, guess what? There is no difference at that point in time. There is no difference between the total cash value and the guaranteed cash value. There is just cash value. And so every time one of these payments is made or a dividend is credited, whatever you thought the guaranteed cash value schedule was gets ratcheted up.
Yeah.
And you have a new scale of guaranteed cash values. And it just keeps going higher and higher if you use dividends to purchase paid up additions, if you keep putting in these paid up addition rider payments. Mm-hmm. And, agents can say things like, well, but the term costs are not guaranteed. And who knows where those could go. Technically, that's a true statement, but those same agents will also they'll sell you a term policy from that company and say, our term premiums have never increased, there are some not guaranteed term products.
Yeah.
So the other thing on that is there are limits to how high you can increase a term premium within a life insurance policy, though they're still subject to the same sorts of guaranteed limits that other components of the policy would be subject to.
Sure.
At the end of the day, knowing what I know, all the years of experience, I have never come across somebody that has made a compelling case to me that paying a higher premium or having a lower cash value for the sake of a higher guarantee has ever made sense.
I'm with you. And that's something I have really appreciated just in getting to know you in our conversations. And when you mentioned, when you look at life insurance companies and comparing illustrations is one thing, but digging into the actual performance, when you had made a statement that if you look at certain companies, a lot of them, especially the top ones, haven't operated in a guaranteed environment. It's been a non-guaranteed environment for what was it, 150 years?
I think that's a pretty good statement to say. For the last 150 years, you would be hard pressed to find, especially with the companies we deal with. Let's say a big mutual life insurance company.
Yeah.
You would be hard pressed to find a single instance where one of those companies operated in a guaranteed environment in the last 150 years. Said another way, they have continuously been paying dividends.
Right.
That doesn't mean that every single policy, literally in every single year, received a dividend, because as you and I know, on a full commission policy, often in the first year or two, those policies may not get a dividend at all, because of the expenses that are being absorbed within the policy. But collectively, these big mutual companies have continuously been in a dividend paying environment. Cash value life insurance is a high margin product. Right. There is a big gap between the guarantees and the non-guarantees. And so there is a big provision for adverse deviation within these products before you would ever get all the way to a guarantee. And a listener might say, well, Scott and Steve, we're getting close to, and maybe we've even passed the interest rate component of that. And on the surface, I understand that seems true, but understand the guarantees on a cash value life insurance policy are not done on a component by component basis. It's not as, and people will say, well, the guarantees on this cash value policy, they use 4% interest and a certain CSO table, a mortality table. And people will think, oh, it's a 4% guarantee. That's not how it works. It's a combination of the two. And I mean, I'll spare you some of the technical actuarial details, but the guarantees on a policy that uses a 4% interest rate are actually higher than on a policy that uses a 5%
Look at that
interest rate.
Yeah.
So anybody who wants to think they can draw conclusions on what interest rate is used in the cash value basis are probably making the wrong conclusions. The larger point is that if we legitimately are concerned about being in a guaranteed environment and we're going to start comparing policies on that basis, we probably should spend as much time thinking about a survival plan. How are we going to fend off the looters from our house? Where is our next meal going to come from? Is our water going to be clean? I hope I don't ever have to live in a world where every life insurance company is operating in a guaranteed environment, because I don't know if the world will continue to operate as we know it in terms of financial systems. And I just fear that the last thing that we would be worried about is the performance of our life insurance policy if we did in fact get into a guaranteed environment. I mean, it would be something beyond which any of us have ever experienced in our lifetimes. And that's saying something. I mean, look at the state of the world right now.
Yeah, it's nuts. Yeah, no. And thanks for mentioning that. And I guess to kind of wrap up, because I know we're out of time, on your point, as far as a non-guaranteed element, and it reminded me of a case study we just completed that I do not have public for several reasons. We were able to obtain several historical policies, some of which were about 40 years old, some were 17 years old. And what I saw consistently is with the top mutuals, I'll mention the ones that I had in the study, were Mass Guardian, New York Life, and Northwestern Mutual. They came up and the internal rates of return were all well above 4%. The one 17-year-old policy was at 4.07%. But my point here is, even today, when you look at the guarantees moving forward compared to the midpoint and non-guarantees, like what you just mentioned, with a lot of the additional information you put in there, it sheds light on that to say, okay, here's how it works. But then when we take experience and see the real data, which I love digging into that stuff when we can get our hands on it, you see, okay, I consistently see when policies are set up right, they're designed like the way you help your clients design policies, you'll see those strong internal rates of return. And in my mind, like that's it at the end of the day. Look at the net cash value. If you've got more cash value, and my goal is to A, use a policy as a bond alternative, B, use it for retirement, or C, I want to leverage it. I'm into the idea of leveraging it over time. If you've got more money, it makes everything much easier.
Yeah, and I have a little story on that too, or just a comment. Isn't it amazing with how widespread the life insurance industry is, and how big the industry is, and how long it's been around? Isn't it amazing that there's not something that compares historical performance? Like, it is impossible to go company by company and say, hey, what's your 20-year, what's your performance over the last 20 years on a policy that's sold to a 35-year-old male with these parameters? And companies could go back and hypothetically calculate that, but they don't want to.
That's the thing. No, thanks for mentioning that, because companies come to us all the time and say, "Hey, sell our product." And my big thing is, okay, looks great, like the flexibility, like what we can do with it. Do you have any historical performance? Because I don't want to put someone in a position where they have buyer's remorse because it just didn't pan out. It just under delivered. And I always get, "Oh, we can't disclose that. But Steve, we pay 135% commission rate on our products." I'm like, well, that's nice, but I don't want to say I don't care, but I don't care. It's like, hey, my goal is not to just drive revenue for myself and the company. It's not. Maximize the cash value. And again, those companies I mentioned earlier are the only ones that have been willing, I'll say, to show it. And then we've been fortunate in working with individuals that obtain new policies through us. They say, hey, I've got a 25-year-old policy through one of these companies. Can you take a look at it? And like, yeah, I mean, it's performing. Keep this thing and keep feeding it as much as you can. But we see the net internal rate of return. I agree. And that is a good business model. Maybe that's something we can figure out to shed light on that. Find policies, historical performance, how much has the design played into it. Yeah, it's fascinating to me. But in my mind, yeah.
There's an incredible difference too between average, good, fair, poor. And I think people think that, I put $10,000 a year into a life insurance policy. How much difference could it be? And I think I probably used this analogy before. Like, I'm buying a car, it costs 10. Well, that's not a very nice car probably, but let's say you're buying a used car for $10,000.
Yeah.
Everybody thinks, I'm getting a car. You're like, what's the difference? But the difference between a great life insurance policy and a poor life insurance policy, I mean, is the difference between a Trans Am and a Datsun or something. And you don't realize it. They might look the same. You might think you're getting the same thing. And what's crazy about life insurance is you might go your entire lifetime, think you own a Trans Am, and never be told otherwise, never realize it, and die. Nobody's the wiser. You actually owned a Datsun your entire lifetime. But life insurance is so confusing. You don't know what the alternate reality is. That unless you work with somebody like you or me, your eyes are never going to be opened to a superior policy. It's crazy. I can't think of another consumer good out there. So I said this once in a presentation, and somebody yelled out from the audience, diamonds. Like, because you don't like cubic zirconia versus a diamond. Like, and so you might go your entire lifetime thinking, you bought your wife this incredible diamond, and it turned out to be cubic zirconia. So maybe that's another example, but you'd be hard pressed to find many examples where there's such confusion and lack of distinction visually, let's say, or from an understanding standpoint, between excellent and poor. And you may never even realize it. Like, I have a lot of people come to me, and these situations are always awkward. And early in my career, I was eager to tell people how poorly their policies performed. And then over time, as I matured and realized that's water under the bridge. Nobody really wants to be told how poor of a decision they made in the past. They want to be prevented from making a similar mistake in the future. So sometimes it's unavoidable that you point out that they didn't optimize something in the past, but what's done is done, once a policy is in force often. But it's amazing how many people come to me and will just say, oh yeah, that I've had that policy for 20 years. It's great. Like, I'm super happy. I've had $1 million of coverage, and I've got, the cash value now is higher than the premium I've put in. And then I take a look at it, and, the rate of return over 20 years is 1% or something like that. And it truly is a dog, and they're blissfully unaware. And that situation is everywhere across America.
Yeah. And I guess we can wrap up with that because I could go on and on about the stories. Real quick, I'll mention, I remember one guy mentioned a similar case. He had a policy with a smaller carrier for a long time. And he's like, okay, yeah, I think this is performing well. Can you take a look? Putting a lot of money into it. And we looked at it. The IRR was somewhere between 1% and 2%. And I just remember distinctly, he looks like, that's pathetic. Like, he thought he was doing so much better, and I don't want to just shift the blame on the agent, because a lot of time the agents, they don't know when they're setting it up. They're trying to learn, and they make adjustments, but sometimes they do what you mentioned earlier. But that stuff happens. And
how about this one? Have you seen an agent add the cash value essentially to the investment performance, and they look at the growth in cash value from one year to the next, and they say, hey, your cash value grew at 8%. But a significant chunk of the 8% growth was due to the premium that was dumped in. That happens so much, it is mind-boggling.
That we just did a series on that because we had some clients reach out, say, Steve, you should do like a video on this to kind of shedding light. I'm like, isn't that like common sense? Like, why would I do that? And he's like, no, like, you should do it because there's so much stuff out there where agents will try and capitalize on that. You put $1 in and you get $2 back. I'm like, yeah, but one of those dollars is the one you paid in. But that's my point. Like, okay, so it's just understanding the net cash value, compounding how it actually works in a policy. And what you mentioned earlier, the dividends, the growth, all that good stuff. Hey, look at the net. That's as transparent as you can get there, and looking at actual performance. But there's a lot of moving parts. And if someone is looking for transparency and they want a resource that's not incentivized to sell them a policy, I mean, you're great for that. People that I've worked with or were in the process with have reached out to you. We'll often encourage them to do so as well. We don't have any kind of relationship where there's any rev share or nothing like that, but it's transparency. And I appreciate that. And I like, we've talked about positioning myself with someone with your level of knowledge because it benefits everyone. So the more we can just spread the message and say, hey, here's how to set things up right, and they've got you as a resource, like, hey, I'm good. I've got maximum cash value. I can do whatever I want with it, but if it's set up for optimum performance from the get-go, I mean, you're going to provide that.
Well, and I think the other thing that to flesh that out a little bit is when I work with a client, I'm not simply limited to, like, let's say that we had a mutual connection and maybe they'd already had a relationship with you. I'm not limited to just looking at policies that you can sell or that you can design. I have the entire universe of policies at my disposal. So if somebody engages me and they want to work with you, I don't approach it from the standpoint of, hey, let's maximize policyholder value within the subset of policies that Steve works with. And that's vast, but I look at it from a broader perspective. And there are some companies that you don't have relationships with. There are no commission policies out there, and if I will tell my client, if let's not let the commission tail wag the dog.
Yeah.
Right? There are some situations where a full commission policy may absolutely make sense. I come across some clients where they want a guaranteed death benefit for a guaranteed premium.
Makes sense.
A guaranteed UL policy. It happens quite a bit in estate planning situations. It's not an income scenario. It's truly a protection scenario. And that's a different kind of policy. I don't even know if you sell those policies, but it's typically a different subset of companies. And so not every case is created equal. Sometimes a client wants term insurance. Sometimes they might want a variable product. And I don't think you sell variable products. And my point is, I'm not beholden to do to make a recommendation that
Yeah.
is within your scope of expertise or your licensing or whatever. I'm doing what's best for the client. And if they want to work with you, if that ends up going your direction, great. I know that you're going to do a good job. I know they're going to be taken care of. I know you're willing and able to implement the policies that are designed optimally. And at the end of the day, I'm looking out for the best interests of my client. We just happen to have a heavy intersection. You've made your practice doing the right thing for clients in this particular type of policy. And I have a lot of clients that happen to come to me that are looking for that kind of policy. So it's been a nice intersection of our practices, but you're correct. You're absolutely correct. We have no financial connection or vested interest in each other's success.
Yeah, and it's just continue to do the right thing, and it'll all grow from in that respect. I mean, if we lost some, because I remember talking to you, some individuals we were working with, talk to you, and like, okay, we're going to look at different companies we don't have access to. I'm like, hey, that's no problem. Do what's in their best interest. The client's always open. We have a great relationship, and if they decide not to work with me, I'm like, hey, that's okay. Like, and that's the thing, because sometimes they feel awkward. I'm like, I don't want you to feel like that. This is your money. It's not about me. I'm always here as a resource. And if we're a fit down the road, that's great. Because in my mind, how that works, and agents hear that, like, what are you, nuts, Steve? People have told me that. I'm like, no, because it's not about one sale. It's not. Help them out, and it's going to come back to you. You can, if I was that individual and someone put me at ease, if something that I was offering was not the best fit, I'm going to be sure to refer them business, provide testimonials, help however I can, and that's going to come back tenfold. Like, that's how I view it, just from a business perspective. It's not about one sale. Again, my mindset is, hey, how do I copy Amazon, right? If we can show every product and design online, where it's convenient for everyone, then it's game over. But that's hard to do. We're working on that. Yeah. But no, really appreciate your time as always. Really enjoy digging into policy design and these topics. I know our listeners do as well. And if anyone has questions listening, we've got our contact in the links below. I'll reach out to Scott anytime. And we hope to talk to you all soon.
Thanks, Steve. I appreciate it.
Very welcome. Thank you, Scott. Enjoy.
Take care.
Bye. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.